The International Energy Agency, IEA, has released a report indicating that electric vehicles, EVs, are set to displace over 5 million barrels of oil per day globally by 2030, with China leading this transformation. This shift is primarily driven by the rapid adoption of EVs, which saw global sales surpass 17 million units in 2024, marking a significant increase from the previous year. The IEA projects this momentum to continue, with EV sales expected to exceed 20 million vehicles in 2025, representing more than a quarter of total car sales worldwide. This change is a critical factor in reshaping global fuel demand and enhancing energy security, especially as China accounts for half of the oil displacement due to its dominance in EV sales, manufacturing, and battery production. China's aggressive push towards electrification is evident, with EVs projected to make up 80% of all new car sales by 2030. In contrast, the U.S. is anticipated to experience more modest growth, with EVs expected to comprise only 20% of new car sales by the same year, due to policy uncertainties and higher vehicle costs. Meanwhile, Saudi Arabia is aligning itself with the global EV transition as part of its Vision 2030 plan, aiming for 30% of vehicles in Riyadh to be electric. The Saudi Public Investment Fund's significant investment in Lucid Motors and the launch of the domestic EV brand Seer underscore the kingdom's strategic shift towards a diversified, lower-carbon economy. This global trend towards electrification, supported by declining battery costs and increased manufacturing efficiencies, is set to further reduce oil consumption, particularly in light-duty passenger vehicles and heavy-duty trucks.
In a recent disclosure to the members of the Scottish Parliament, MSPs, NatWest revealed that it faces an astonishing 100 million cyber attack attempts each month. This figure underscores the massive scale of digital threats targeting financial institutions today. The bank's defensive measures include blocking approximately 1/3 of incoming emails to mitigate potential breaches. This revelation highlights the increasing sophistication of cybercriminals, who are now leveraging artificial intelligence (AI) to enhance their strategies by building trust with potential victims before launching attacks. The implications of such a high volume of cyber threats are significant for both NatWest and the broader financial sector. For NatWest, maintaining robust cybersecurity defenses is crucial to protecting sensitive customer data and maintaining trust. For the industry, this serves as a reminder of the persistent and evolving nature of cyber threats, which can have far-reaching consequences, including financial losses and reputational damage. As AI continues to be a tool for both cybercriminals and cybersecurity professionals, the arms race in digital security is likely to intensify, necessitating ongoing investment in advanced security technologies and strategies.
American Eagle Outfitters has withdrawn its financial guidance for 2025, citing macro uncertainty as a driving factor. This announcement has caused a significant drop in the company's stock, which fell over 14% in pre-market trading. The retailer also revealed plans to write down $75 million in spring and summer merchandise due to disappointing merchandising strategies that led to excess inventory and increased promotional spending. As a result, American Eagle anticipates a first-quarter revenue decline of 5% and a same-store sales drop of 3%, alongside an expected adjusted operating loss of approximately $68 million. The decision to pull financial guidance aligns with a broader trend among companies facing uncertainties due to a U.S.-led trade war, which has affected consumer confidence and spending patterns. CEO Jay Schottenstein acknowledged the company's missteps in the first quarter, but expressed optimism for the remainder of the year, citing improved inventory alignment with sales trends. Analysts, such as Paul Legez from Citi Investment Research, anticipate that American Eagle will focus on inventory reduction and cost control in response to ongoing margin pressures from tariffs, promotions, and freight costs. The company's first-quarter financial results are scheduled for release on May 29th, which may provide further insights into its strategic adjustments and future outlook.
The Euro-USD currency pair has recently surged past the 1.1200 mark, driven by a weakening US dollar following the release of US inflation data for April. The Consumer Price Index (CPI) showed a year-over-year increase of 2.3%, slightly below the anticipated 2.4% and the previous month's 2.4%, leading to a decline in the US dollar's strength against the euro. This movement has been further supported by technical factors, as the Euro-USD broke through the 50% Fibonacci retracement level at 1.1245, indicating a potential continuation of the bullish trend towards 1.1287 and 1.1300. Investors are closely monitoring speeches from central bank officials, particularly from the Federal Reserve, to gauge future monetary policy directions. Fed Governor Christopher Waller's remarks are of particular interest, as he has been known for his dovish stance, suggesting potential rate cuts if economic conditions warrant. The market is also reacting to geopolitical developments, including US-China trade negotiations, which could influence central bank decisions and, by extension, currency movements. As the Euro-USD maintains its upward trajectory, traders are advised to watch for any shifts in sentiment from central bank communications that could impact the pair's direction.
Netflix has announced that its ad-supported tier has reached 94 million monthly active users, marking an increase of over 20 million users since November. This growth highlights the company's strategic pivot towards incorporating advertising to enhance profitability within its streaming services. The ad-supported plan, priced at $7.99 per month, offers a significant discount compared to Netflix's lowest ad-free plan, which is priced at $17.99 per month. The affordable pricing and the ability to attract a younger demographic, particularly 18 to 34-year-olds, have positioned Netflix's ad tier as a formidable competitor to traditional U.S. broadcast and cable networks. The surge in users for Netflix's ad-supported tier underscores a broader industry trend where streaming giants are increasingly relying on advertising revenue. This shift aims to offset rising content production costs and cater to a price-sensitive audience. Netflix's president of advertising, Amy Reinhart, emphasized the high level of engagement with ads, suggesting that viewers pay substantial attention to mid-roll advertisements, comparable to the shows and movies themselves. This development not only strengthens Netflix's user base, but also potentially enhances its attractiveness to advertisers seeking to capture the attention of young, engaged audiences.
Ethereum ETH/USD has experienced a significant 65% rally over the past month, outperforming other digital assets, according to a report by Bernstein. This surge is attributed to a combination of structural and tactical factors. Firstly, there's a renewed focus on blockchain utility through stablecoins, with Ethereum being a major player as it accounts for 51% of the minted stablecoin supply. This positions Ethereum as a critical infrastructure layer in the digital currency landscape. Secondly, rising institutional interest in Ethereum's Layer 2 ecosystems is driving demand for ETH. Layer 2 solutions, which use Ethereum for transaction fees, are gaining traction, evidenced by Base's $85 million annual sequencer fees and Robinhood's acquisition of WonderFi. These developments suggest a growing adoption of Ethereum's network capabilities. Additionally, a tactical shift among crypto hedge funds has contributed to Ethereum's momentum. Previously, these funds maintained a delta-neutral strategy by being long on Bitcoin and Solana while shorting Ethereum. However, as the focus shifts towards blockchain utility and institutional adoption, hedge funds are unwinding these short positions on Ethereum. The broader implications of this rally are positive for the digital asset ecosystem, benefiting crypto exchanges and broker-dealers by reinvigorating retail trading activity. As Ethereum's narrative evolves, it reflects a larger trend towards the integration and utility of blockchain technologies in various sectors.
Shopify, SHOP, is poised for a promising future following a robust Q1 performance and its impending inclusion in the NASDAQ 100 and NASDAQ 100 equal-weighted index. The company reported a 27% year-over-year increase in revenues, reaching $2.36 billion and a 22% rise in profit. This growth is largely attributed to the impressive expansion of Shopify payments, which saw a 31% increase in processing volume and a significant 109% surge in B2B gross merchandise volume, GMV. The company's strategic focus on high-margin products and cost optimization has resulted in a 56% jump in free cash flow, highlighting its financial discipline and operational efficiency. The market's initial reaction to Shopify's earnings was surprisingly tepid, with a slight dip in stock price. However, analysts maintain a bullish outlook, with a consensus price target indicating a potential 12.5% upside. The stock's forward price-to-free cash flow, PFCF, multiple is projected to decrease, suggesting a more attractive valuation as the company continues to scale its operations globally. With a strong net cash position of $5.3 billion and potential for future capital returns through buybacks or dividends, Shopify is well-positioned to attract a broader investor base and sustain its growth trajectory.
Supermicro Computers Supermicro has faced investor skepticism due to financial reporting concerns, including auditor resignation and delayed filings, which previously threatened potential delisting. While these issues appear resolved, the company still grapples with significant challenges, particularly its declining gross profit margins. Gross margin, a critical financial metric indicating revenue remaining after covering the cost of goods sold, has been deteriorating for Supermicro. Despite a 19% increase in net sales to $4.6 billion, driven by demand for storage and server solutions, the company's gross profit fell by 26% to $440 million, highlighting the adverse impact of shrinking margins from over 15% to under 10%. This downward trend in profitability raises concerns about Supermicro's valuation and future growth prospects. The company's recent quarterly net income dropped to less than $109 million, marking the lowest level since 2023, and its forecasted earnings per share (EPS) for the current quarter suggest it trades at about 21 times future earnings, aligning with the S&P 500 average. However, this valuation assumes sustained demand for tech infrastructure, which remains uncertain in the current macroeconomic climate. Despite a nearly 60% drop in share value over the past year, Supermicro's slim margins pose a risk, potentially making the stock appear more costly than its price suggests. As a result, investors may consider monitoring the stock closely rather than adding it to their portfolios, given the inherent risks and volatility.
New York Attorney General Letitia James has filed a lawsuit against Capital One, accusing the financial institution of misleading customers about their savings account interest rates, resulting in millions of dollars in lost interest payments. The lawsuit claims that Capital One marketed its 360 savings account as a high-yield savings option, but failed to inform customers about the newer 360 Performance Savings account, which offered significantly higher interest rates. As interest rates climbed in 2022, Capital One allegedly maintained the 360 savings account rate at 0.3%, while the performance savings account rates increased to as high as 4.35%. This legal action mirrors a previous suit by the Consumer Financial Protection Bureau, CFPB, that was dropped earlier this year under the Trump administration. The CFPB had alleged that Capital One's marketing practices led to U.S. customers missing out on over $2 billion in interest. Capital One has denied these allegations, stating that their 360 Performance Savings product was widely marketed and accessible to all customers. The New York AG's lawsuit seeks restitution and damages for affected customers, highlighting ongoing scrutiny and legal challenges faced by financial institutions over consumer protection and transparency.
Wedbush analyst Daniel Ives has highlighted a significant development in the artificial intelligence sector, focusing on the burgeoning AI revolution in Saudi Arabia and the broader Middle East. At the recent U.S.-Saudi Investment Forum, NVIDIA announced a pivotal agreement to supply 18,000 GB300 Blackwell chips to Saudi-based AI startup Humane, which is backed by the nation's sovereign wealth fund. This move is seen as a strategic pivot by the U.S. to enhance AI capabilities in the Middle East, potentially positioning Saudi Arabia, UAE, and Qatar as key players in the global AI landscape. Ives emphasized that this development is particularly bullish for major tech firms like NVIDIA, Tesla, Palantir, Microsoft, Alphabet, and Amazon, as these companies are likely to benefit from increased demand for AI technologies and infrastructure in the region. The broader implications of this development could be substantial, as it signifies a shift in the geopolitical tech landscape, with the U.S. potentially redirecting its AI chip supply focus from China to the Middle East. This comes amid ongoing tensions and trade restrictions with China, particularly concerning advanced technologies. The market has responded positively to these announcements, with NVIDIA's stock experiencing a notable rally, contributing to the company's re-entry into the $3 trillion market cap club. This strategic realignment could significantly expand the total addressable market, TAM, for AI solutions, offering new growth avenues for U.S. tech giants and further entrenching their presence in the Middle East's rapidly evolving digital economy.